Goldfields' first quarter headline earnings per share slipped 18.7% to 290 cents. That's as production was seasonably lower due to the extended Christmas break. Joining us now to unpack the numbers is the company's CEO, Nick Holland. Nick, good to have you with us on Open Exchange today. Let's start with the production numbers that we saw coming through for quarter one. 827,000 ounces, a 6% drop in production. Take us through production across the board and why that softening that we saw.
Well, first of all, I think this quarter, as you've mentioned, does have the Christmas break in South Africa in it, although it's not the December quarter, because we close off just before Christmas in the previous quarter and we shut the mines in South Africa for 2 weeks. We see the full effect of that in this particular quarter. And in fact, it's more than 2 weeks because it takes us another week to make safe, test everyone again. So this is not unexpected at all.
Is that not a seasonal factor, though, that you look at every Christmas?
Absolutely.
Yeah.
So if you look at this quarter's production compared to the same quarter in 2011, our production was very similar.
So where's production across your various mines? Take us through the mines that are performing well and the mines that are disappointing right now.
Look, all of them, by and large, are performing in line with expectations. You know, as I've said, in the March quarter of 2011, we did 830,000 ounces. This quarter we did 827,000 ounces. So we're very close to what we expected to be overall. You know, certain mines have done incredibly well. Tarkwa in Ghana had a fantastic quarter, 185,000 ounces, 15,000 ounces up. South Deep is similar to the previous quarter. KDC, if you strip out the seasonal adjustments, it's pretty much what we would have expected to see. Damang is slightly off and Agnew is slightly lower than the previous quarter, and that's linked to geotechnical issues at Agnew, which have required us from a safety perspective to slow down. And at Damang we've also encountered some difficult parts of the very mature pit, Damang pit, that we're mining there, and from a safety perspective we've pulled back there. And as you know, safety is something we never compromise on. That's the main reasons why those particular operations have pulled back.
Nick, good morning. I just want to look at how you're going to expand this business. I mean, apart from the more efficient exploitation of your existing reserves, are there any assets out there, any gold assets that are reasonably priced that you're looking at, or are they all too expensive because of the extraordinary run we've had in the gold market and because of competition from your peers?
Well, certainly what we've seen over the last 4 months or so is, uncharacteristically, we've seen gold equities in fact disconnect even more from the gold price. And I know that the gold price, of course, has come down from the highs of around 1900, but what we've seen is gold equities in fact have disconnected even more in relation to the gold price. And we're seeing the so-called gold multiple, as it were, almost vanish relative to the fundamental value. Interestingly enough, though, gold companies are still trading at a premium to base metals. So the allure of gold and the gold is money concept is still inherent in the values of the various gold stocks, but they have become a lot cheaper. We've always said we don't necessarily subscribe to M&A activities as a core strategy to grow the business, but we also realize that M&A, of course, is opportunistic. And if we do see opportunities for us to buy assets that are stressed or that are likely to be disposed of because of a strategic change of direction, and we think we can bring to bear our skills and resources to liberate additional value, you know, we're always keen to do that. And if you look at our acquisitions over time, those are the kind of acquisitions we've made.
Tell us about the cost of extraction right now. What is the cost to Goldfields to extract an ounce of gold?
Well, the cost to Goldfields in this particular quarter to extract an ounce of gold was about $1,280 an ounce, all in. That's capital expenditure, that is exploration costs, operating costs. If you look at the gold industry at large, we're not the highest, and we're certainly not the lowest. We're probably in the middle. The average cost to extract an ounce of gold in the gold industry is probably around about $1,400. So $1,500 is the long-term price we use as almost a floor price.
Yeah.
And if it goes lower than that, then clearly the industry is going to be under stress.
Nick, before we let you go, what is the focus now for Goldfields? Is it on efficiency, cost management? Is it on trying to look for areas where you have greater gold deposits, or how are you looking to position the company in light of the fact, as you say, the share price down 30%?
Well, first of all, I'm going to continue to focus on safety and health. We employ 50,000 people, and this is a people business, so we're going to focus on the safety and health of those people. If we do that, we have the resources and the skills to keep this company going for the next 50 years, which is what we want. In the meantime, we're going to continue to diversify the company away from an overexposure to South Africa. As I mentioned, 2 years ago, we had 2/3 of our production coming out of South Africa. For a global gold company, that's too much. 2/3 in any region would be too much. We're now down to 48%, and our plan is to get that down to 40% over the next 3 years. South Africa will always be an important part of the portfolio. South Deep is a wonderful asset, but we want to get a more balanced spread. And we've seen the impact of companies that are overexposed. Randgold, I think, had some concerns with their exposure in Mali, and I think they're obviously going to consider the impact of that on their business. And the same could happen elsewhere. So companies should never be too overexposed to any particular area, and that's going to be our strategy.